Welcome to Cushman & Wakefield Greater China's second quarter capital markets webinar with a spotlight on the dynamic city of Guangzhou, nestled at the heart of the exciting Greater Bay Area. I'm James Shepherd, Head of Business Development Services for Cushman & Wakefield in Greater China. It's been an exciting second quarter here in China as we celebrated the 100th anniversary of the founding of the China's Communist Party in July, which was closely followed by some robust economic results for mainland China last week. But before I go into all of that, let me tell you about the excellent speakers that we've lined up for you on today's panel. We're honored to have George Hongchoi, Executive Director and Chief Executive Officer of Link Asset Management, joining us today from Hong Kong. George was named one of Harvard Business Review's 100 best performing CEOs in the world for 2019, the winner of the Hong Kong and Macau region in the EY Entrepreneur of the Year Awards in 2017, Business Person of the Year by DHL's SCMP Hong Kong Business Awards in 2015, and was also presented with the Director of the Year Award by the Hong Kong Institute of Directors in 2011. Under his leadership, Link has grown from a domestic player in Hong Kong to a regional leader with a diversified portfolio worth 200 billion Hong Kong dollars, including retail facilities, car parks, and office buildings, spanning Hong Kong, Beijing, Guangzhou, Shanghai, Shenzhen, London, and Sydney. From the Cushman & Wakefield side, I'm delighted that today we have Francis Lee, Sylvia Su, and Catherine Chen. As many of you will know, Francis is a prominent expert on China investment who has maintained hands-on experience in Hong Kong, mainland China, and Taiwan for over 36 years. Francis has successfully closed a huge number of high-profile transactions over his career. More recently, in 2019 and 2020, 51 major transactions were completed by the Cushman & Wakefield Capital Markets team in Greater China under Francis's leadership. The total consideration of these exceeds 72 billion renminbi. Sylvia Su heads up Cushman & Wakefield's capital markets team in Guangzhou and has worked with Cushman & Wakefield for over 20 years. Over this time, she's developed an extremely strong real estate market sense and has established excellent relationships with landlords and developers throughout the region. Sylvia focuses on deal sourcing and providing professional advice on real estate investment deals, including structuring and analysis and due diligence, so as to support effective closing of transactions between buyers and sellers. Sylvia will be presenting on the Guangzhou spotlight today. Also on today's call is Catherine Chen. With over a decade spent working with Cushman & Wakefield, Catherine is our subject matter expert for capital markets research in Asia Pacific, based in Hong Kong. Prior to this, Catherine has led and worked on many research and advisory projects for multinational investors and developers, and has an extensive knowledge in Greater China commercial real estate market, and has spent time working in North America, Shanghai, and is now based in Hong Kong. Catherine will be hosting today's panel discussion. With that, let me run through a quick update on the Greater China market overall before I hand over to Sylvia. On the left, the urban employment situation continued its rapid recovery, down to just 5% unemployment by May. In fact, the employment situation now boasts a better reading now than it did prior to the COVID outbreak in December of 2019. This bodes extremely well for ongoing support of commercial real estate demand. And on the right, we can see how in the first quarter of the year, we saw the services sector in red accelerate, now accounting for almost 60% of China's overall employment. This strong recovery in employment is no doubt driving office-using jobs. You will see later when we get to the exceptionally strong office absorption figures in a few slides. In the mainland, sentiment remains positive, as the PMI here on the left in red held positive territory for the 15th consecutive month, as Hong Kong PMI started to demonstrate some sustained resilience for the fourth month in a row and posted the highest PMI reading within the last 3 years at 50.5 in May. Retail sales on the right demonstrated ongoing recovery, albeit from a very low base in Q1 last year. The mainland China real estate investment chart on the left is largely weighted to investment in new construction and excludes land sales. We can see a significant change register in February for the first 2 months of this year in comparison with the first 2 months of last year. However, by May, this is moderated significantly, particularly in the office and retail sectors in grey and dark blue, registering just 6% growth, when looking at the 5-year months of last year compared to the first 5 months of this year. This is likely to moderate further through Q3. Despite the relaxation of the reserve ratio requirements, which was effective July 15th, with the ongoing close scrutiny on the real estate sector debt, the 3 red lines remaining firmly in place, and with land supply restricted in core areas of many cities, it's not impossible that this may again return to negative growth territory in the office and retail sectors, given the boom in supply experienced over the past decade. This suggests that lower office supply levels within the next 2 to 3 years seem quite likely, though as we will see from the next page, that's not exactly what we're hearing from the development community. According to developers' schedules provided to us, a massive 33 million square meters of supply is planned over this 5-year period, suggesting an average of around 6.6 million square meters annually. But 6 months into 2021, with an immense 10 million square meters slated for this year, so far we've only seen 24% of this delivered. If we look at historic construction delay trends, coupled with the debt situation, it seems unlikely that developers will be able to realize more than 75% of this, which suggests average annual supply will struggle to hit the 5 million square meter mark, as indicated in the red dotted line on this page. This chart shows the key office markets we track across Greater China. The red diamonds show the ratio of new supply over 5 years in relationship to existing stock. Despite the potential for lower levels of supply than developers' schedules may suggest, many markets on the left-hand side of this chart will see significant supply in relationship to the existing total market stock, given the sheer volume of projects under planning. Conversely, for markets on the right-hand side, supply pipelines appear and will likely remain more modest in comparison to existing stock during this period. So how about demand? Well, I'm pleased to report we've seen a stunning recovery in absorption since Q1 2020. On the left, quarter after quarter absorption has increased, culminating in Q2's absorption totaling over 1.7 million square meters of office space, largely weighted to the first-tier markets. For H1, the total net absorption in Greater China markets exceeded 3 million square meters, and this is equivalent to leasing the entire Grade A office stock of Sydney in 6 months. Excitingly for Guangzhou, despite a slightly slower Q2 than Q1, in total, H1 absorption was not far off that in Beijing, which is really saying something considering that Beijing is more than twice the size of Guangzhou in terms of Grade A office stock. Generally, these suppressed levels of supply and strong absorption have led to declining vacancy in the markets on the left-hand side, including Guangzhou, where vacancy is again looking more healthy for property owners at just 7%. Even in Beijing and Hong Kong on the right, where the vacancy trajectory was still on the incline, the rate of growth had slowed markedly, indicating potential for these markets to turn the corner on this period of weaker occupancy rates. Despite the general improvement in occupancy, rentals still appear to be softening in the market overall, though the rate of decline has moderated significantly. On a year-on-year basis, most markets demonstrated negative rental growth, though Q2 data suggested an increasing number of markets were starting to turn a corner and experience rental growth once again. Guangzhou rentals in green on this chart have demonstrated a comparative resilience to the tough COVID-induced economic conditions since the initial outbreak. Transactions in the first 6 months of this year totaled 130 billion renminbi, approximately half of the transaction volume we saw for the whole of last year, a reasonable start in light of the challenging situation. Impressively, despite ongoing travel restrictions, inbound investment managed to command a 26% share of this, similar to the share we witnessed in 2019 prior to the pandemic. On the left-hand side, we can see increased share of investment weighting towards Beijing and Shenzhen in the lower left-hand pie chart, which represents the first 6 months of this year. We also note a slowdown in activity in second-tier markets, down from a 14% share in 2020 to a much more modest 4% share in H1 2021. Despite Guangzhou's ongoing and increasing appeal to the investment community, it also witnessed a small decline in the overall share. It's worth noting that this was likely more as a result of the ease of transacting in softer market environments elsewhere, and also reflects the challenges some investors have found when trying to secure or source quality investment opportunities and deploy capital in this nuanced market. We will ask Sylvia to shed more light on this later. Sector-wise, office and R&D remained the preferred asset category, albeit the share was lower than 2020. Retail maintained an 11% share, while apartment and mixed use saw growth. The apartment sector sees growth on the back of 2 major deals in Shanghai and 1 in Beijing. Industrial was down, likely as a result of limited availability on a market opportunity and aggressive pricing in the logistics sector. So with that, I'd like to pass you over to Sylvia to take a look at the Guangzhou market in a bit more depth.
Thank you, Jimmy's GC market update. I'm Sylvia from Guangzhou. From mid-May to June, Guangzhou drew all your attention on COVID-19, right? But thanks to the quick response to local government, and the pandemic was well controlled in a month's time, and the city come back to normal as usual. Let's start from the macro economy. Among the 4 Tier 1 cities, Guangzhou's GDP in 2021 Q1 was about 640 billion yuan, with 19.5% year-on-year growth. The national growth rate was 18.3%, so in these 4 cities, only Guangzhou outperformed the national growth. Let's look at the macro indicators on the left-hand side. Guangzhou has a very good performance in investment and consumption. The growth rate of investment is quite eye-catching, with an average growth rate of 13% in 2 years. Compare 2.3 of Shenzhen, 4.8 of Beijing, and 7.4 of Shanghai. Consumption growth is also outstanding due to the city has attracted a large amount of net inflow population. According to the latest census data on the right, Guangzhou's permanent population in 2020 increased about 5.9 billion in 10 years' time. I guess this is why the investors are favored in retail section. So strong economy performance led to very active office market. In the slide showed Guangzhou Grade A office market data among Tier 1 cities on the left, and stock supply and vacancy rate on the right, sorry. It shows that the take-up was very strong in the first half of 2021, which reached over 300,000 square meters. Is equal to total amount of entire 2019 and 2020. Also, over 120,000 square meters, which is about 40% of the total take-up, come from new leasing and upgrading. The vacancy rate record 7.2% in the first half, which is the lowest in Tier 1 cities too. It shows a continued new demand for Guangzhou office market. We continue to see the retail market. Similar to Grade A office market, retail market also show a strong net take-up and low vacancy rate. The net take-up was 466,000 square meters, and the vacancy rate was about 4.5%. So even though Guangzhou has the largest new supply among the Tier 1 cities, we still have the lowest vacancy rate and the largest take-up. You may wondering why the performance of retail in Guangzhou kept an upward trend, even though there is a pandemic in May and June, right? I think this is mainly benefit from the government's precise measures of controlling. The COVID-19 was strictly controlled in community or limited units of residential, so the majority retail have not been affected by the spread. Let's continue to see investment transactions of Guangzhou. Let's take a look at the red bar on the slide. In the first half of 2021, we recorded 9 transactions were closed with a total of 8.8 billion yuan, 80% year-on-year increase. In these 9 deals, 65% were closed by foreign investors, like Lingric acquired Happy Valley at 3.2 billion RMB, and a foreign fund acquired a hotel in Tianhe district. The rest are closed by domestic. For example, there is a game company has bought 50,000 office area in financial town for self-use. The share of transactions by sector in first half is quite different from the previous year. As I mentioned just now, for Lingric's Happy Valley deal, the share of retail investment surpassed that of office sector, which dominate more than 1/3 of transaction volume. We also noticed that the share of hotel investment has also increased. The share of retail and hotel accounted for nearly half of total. As we all know, retail and hospitality are the sectors that probably have the most direct impact from the COVID outbreak because of virus, social restrictions, and lockdowns. But there are still retail and hotel deals closed in this period of time. I do see the investors' long-term confidence in Guangzhou's business environment and their ambitions to entering GBA by investing Guangzhou as the first step. Different from other cities in China, Guangzhou has a lot of remarkable retail deals in the past 5 years. In this slide, we list out some of them. It's no doubt that Lingric's Happy Valley was the largest transaction in Guangzhou in the first half of this year. This project is the largest standalone shopping mall in CBD area with 90,000 square meters. I will leave more details to George, CEO of Link, to tell us about their strategies. Besides this project, both Link Plaza, Rock Square were transacted twice. Active retail transactions were supported by strong consumption ability and continued inflow of population of the city. At last, I'd like to summarize a few points of second half of 2021. After experiencing the COVID-19 in May and June, Guangzhou's economy have shifted back on track. At the same time, Guangzhou government will continue to increase investment in infrastructure, like upgrade the railway stations and expansion of airport and exhibition center. It will strengthen cities' competition ability. Urban renewal will become the new main focus in the next decade. There are 38 villages will be redeveloped in the next 3 years. The core areas will be relieved more valuable investment opportunities to the market. With all the points mentioned above, I expected the transaction volume will continue to increase. That's all of my share of Guangzhou capital market. I will hand it over to Catherine. Thank you.
Thank you, Sylvia, for taking us through the Guangzhou investment market. Now we are ready to answer your burning questions. As shown on the screen here, you may submit your questions by clicking on the Q&A box located on the top right-hand corner of your window. And I'd like to remind all panelists to turn on your camera on to show your beautiful faces. I already see a number of questions coming up, and the first one is regarding Link's recent acquisition of 2 shopping centers in mainland China. So let me ask this question to George. Are these 2 deals a reflection of the overall level of confidence you have in the mainland China market, or a reaction to COVID-19 to take advantage of more favorable pricing?
Thank you, Catherine, and thank you for inviting me to come and share with all of you our experience. Yes, I think on a macro level, we are very confident of the mainland China retail market has rebounded a lot faster than other markets around the world. But each acquisition, obviously, opportunistic in nature. We look at it on an asset-by-asset basis. So if you look at the two acquisitions that we've done in Guangzhou, both of them we see there are asset management upside. There are vacancies that we can fill. There are a lot of leases up for renewal or for replacing tenants. And so we believe that rather than just looking at the yield at the time that we acquire the asset, we managed to improve the income at Ling Plaza Guangzhou over the last few years. We believe we can do the same with Happy Valley over the next few years. There is a department store that left the property a few years ago, and we are now working on plans to renovate that area and reopen that area into new shopping offering for a very attractive location. So it is on a macro level very bullish, but asset by asset, we are also quite cautious, but we think we picked two very good assets in Guangzhou.
Thank you very much, George, for your insight on this. The China retail market has certainly seen a very strong recovery recently. And I see the next question here asked about the office market, and I will ask this one to Francis. Where do you see investment opportunities in offices are, given the softening rentals in most cities and an influx of future supply?
Thank you, Kathleen. Early on, I think Jamie had given us a very encouraging news. In the first half of this year, I think the office take up in China is a total like 3 million square meter, which is equivalent to the market size of Sydney. I think this is very, very encouraging, especially the take up in Shanghai, in Shenzhen, even in Beijing, Guangzhou. I think those are four first-tier cities are very, very performing very well. And also, Jamie showed us that in terms of asset class, in the first half of this year, I think office still, and also the R&D facility still account for something like 52%, which is more than half of the transaction volume in total. And in terms of the city, I think still pretty much investors are preferring like a city like Shanghai and Beijing, which is the bigger market and also high liquidity, and also the transaction I think is more active. So if you give me the saying that I think is still very much towards the T1 city in terms of the office investment demand. And also apart from leasing and investment, I think end user buyers are very active too. As Sylvia said, that in Guangzhou, some of the buyers taking up 50,000 square meter for their own use. And also in Shanghai, I think lately there's a news saying that the TikTok had bought like 240,000 square meter of office building for their own occupation in just this month. So I think we're very encouraged that with the economic recovery, I think demand for office is very healthy and strong.
Thank you, Francis. So speaking of office, I see a question asking about Guangzhou's office market. And Sylvia, you have mentioned Guangzhou's office vacancy rate has remained quite low, under 10% for a number of years. What do you see are the top demand drivers in Guangzhou's office market?
I think TMT will be the main active player in the market. Well, according to our data, they took over about 35% of total leasing areas. Like Toutiao.com is called 今日头条 in Chinese, who is a subsidiary of ByteDance, rented 30,000 square meters. And Jindie Kingdi is a software company, also rented 4,000 square meters in Zhoutafu Financial Center. And Meituan also have another 30,000 square meters for operation center in Tianhe. So I think TMT is quite active. Also, retailers are also another group of active driver. Like Miniso, we call Minchuang Youping, is a local retailer, rented 30,000 office area in Pazhou. And I think financial and energy companies also take very large scales. For example, AIA Insurance have rented 3,300 square meters in IFC, and a company called China Petrol Pipeline Company have about 10,000 square meters in Wanke Zhongxin. It's easily to list out a lot of this kind of leases in Guangzhou in the first half of this year. So you can see this TMT retailers, financial companies and energy companies are quite active. They are the main market drivers.
Thank you, Sylvia. So aside from the booming TMT retail and insurance sectors, Guangzhou is also well known for its gourmet and food culture. No surprise, I see another question asking about Guangzhou's retail market. And I think this question is perfect for George. With recent acquisition of Happy Valley, Link Re now owns 2 major shopping centers in Guangzhou, together with Link Plaza. Could you share some insights on these 2 deals, and what's your long-term vision in Guangzhou's retail market? George.
We see the consumption pattern changing. People are spending more. The household income's been growing. The middle class household numbers have been increasing as well. And so when we started looking a few years ago, we come across Link Plaza Guangzhou. At that time was a core metropolitan plaza, and thanks to your Francis and your colleagues, we have been introduced to that property. The asset will be owned on a long-term basis. We have done 1 round of upgrade. When we bought it, I think there are certain hardware that need to be upgraded. We also have improved the connectivity with the subway station. When we bought it, a few of the entrances has not been open yet, although the mall has been open for some time. So this sits on top of the metro station with Line 1 and Line 6, 2 of the busiest metro line. It has excellent connection, and it also fits our general investment guideline, is that let's try and find some asset where we can do business for 7 days rather than only Monday to Friday or weekend. And at the Li Wan area, there is tourists, there is commercial activities during the week, but also a lot of residential. So that fits very well. And Happy Valley seems to fit similar pattern in between the central business district of Zhujiang New Town and also the Guangzhou International Financial Town. There is the Maqiang potential redevelopment of that whole area, where there will be a lot more population coming in, both commercial and residential. The subway station is nearby, and we see new lines coming. And the passing rent for Happy Valley is lower than other well-managed malls in the district. So we believe that we can put some excitement back after the renovation of the mall. We can bring a lot of shoppers back to Happy Valley shopping mall. There is no sort of large mall to the east of this property. So hopefully this is the gateway, the first mall that they will visit as they come towards Zhujiang New Town. And so we are leveraging on our experience with what we have done at Link Plaza Guangzhou over the last few years. Some of our colleagues have moved to Happy Valley to help us lead the transformation, and we've hired new people as well. And so with our bigger team, hopefully that help us to underwrite the next investment that we come across.
Thank you, George. And I see a follow-up question for you. As a Hong Kong-based investor with assets in both Guangzhou and Shenzhen, what are the key differences that you see in consumer market among these 3 cities? Do you apply the different investment or operational strategies, especially in Guangzhou?
Guangzhou is a bit easier for us. We're part of the Greater Bay Area, but also in Hong Kong people, all Cantonese, mostly Cantonese. So the taste very similar. The way that we think about trade mix, more similar. I think the big difference is that in Hong Kong there is more of a reliance on tourists, and especially tourists from mainland China. Although our mall tend to be more community-based, and so there's less reliance on tourist trade, but still the whole economy is based on that. Guangzhou more domestic, and more impact from online, obviously, online shopping. So what we're learning in Guangzhou, we hope that we can get ourselves ready for increasing online shopping in Hong Kong, which have a slower start. We think that the leisure element is still very important. We see, last year, those trade that has been hurt, obviously restaurants with capacity constraint, cinemas were closed for a while. But very soon, as these restrictions are removed, people come back to shop right away. And so there are similarity. There are other things that we have done in Hong Kong, which we think we can apply very quickly to properties in China. One of the things that we have done a lot is energy savings. We have all our property in Hong Kong connected to building management systems, and trying to cut or manage our electricity usage. So those are things that we will apply to our property in Guangzhou. Obviously we have other assets in Greater Bay as well, especially Central Walk in Shenzhen. And that is undergoing a very significant renovation exercise. We decided not to close the mall. Part of it are still operating, which obviously a bit of a impact on our current tenant. But we want people to see this slow transformation over these few months. It will fully the project will fully complete by the end of this year, and I'll invite you all to come and visit Central Walk, which will look very different from what it was before.
Can't wait for that. Thanks again, George, for insight on the GBA cities. I see a more challenging question asking about Hong Kong-based investors investing in mainland China, and I will ask Francis about this one. And George, please feel free to weigh in. So as Hong Kong is now facing a difficult time, especially in the office and retail market, do you expect Hong Kong-based investors to allocate more capital in the mainland China or perhaps also outside China?
Thank you, Kathy. I think the situation in Hong Kong is we're still facing a lockdown, that travel have been banned, especially when we return from outside. We have to have a quarantine of 14 or 21 days. So the traveling between Hong Kong and outside Hong Kong is a big challenge. So the investor having capital is still looking basically into the residential sector, which is very active. And also we did see in the last 2 months, a lot of on-block industrial building have been taken up, and another very active market. And other than that, I think people like Lingrid, George, they have the team on the ground in Guangzhou, in Shanghai. I think they're still actively studying to acquire more assets, taking the advantage of the market. And we did see investor also picking up property maybe in London, city like London, given most of the investors, they also have a team on the ground. So investor who have local support definitely have the advantage of doing deals in this market when the traveling is not easy at all. So I would say that given Hong Kong, we are towards saying that the boundary will be opened up soon. So I expect more capital will be coming in and also going out. So we won't let Hong Kong to be too quiet for too long.
Anything to add, George, from your side, from Lingrid?
Yeah, we have continued to focus on how to grow our portfolio. And one of the things that we have done over the last few years is to improve our portfolio mix. So we have sold some of our assets and buying better assets. The way I'll describe it is that, you know, before I go on, you know, thanks to Cushman's involvement also in the disposal. So in improving the portfolio mix, one of the things that we've done is we have sold a lot of the smaller assets and buying bigger assets, looking to do so in Hong Kong, but haven't been able to find as many good ones. So we have looked at in China. And the difference between the larger and the smaller asset is that the expense-income ratios tend to be much lower for the larger assets. Our marketing effort and leasing effort seem to be much better rewarded for larger assets. So the whole portfolio actually have improved as a result. And we're looking at how to continue to do so to build a resilient, you know, as you know, obviously there's a real estate cycle that we have to handle. And the diversification across different markets really to allow us to not be affected by one market as much as the others. And so diversification is something that we started a few years ago and will continue to do it going forward.
Thank you, George and Francis. Now coming back to Guangzhou, we know that Guangzhou recently had a resurgence of COVID cases, and I will ask Sylvia, how did investors, landlords, or occupiers respond to the COVID outbreak and the impact you've seen on the office or retail market?
Thanks, Catherine. I think during the COVID outbreak, occupiers have remote office or work at home this style, and some of the companies have shifted their business to online as much as possible. So in a short period of time, this have some effect on investors and landlords. But remote office is quite different, or I say it's difficult to completely replace centralized office in terms of work efficiency and communication efficiency. So in the long run, after COVID-19 be well controlled, the impact will be limited. For retail, in the first half of 2020, the opening schedule of most shopping malls have been postponed, and there have been a short-term increase of vacancy rate because of the restrictions and lockdowns. But however, from the second half of 2020, the pandemic was effectively controlled. So the sales performance of shopping malls have been rebounded significantly. As I mentioned in my previous PPT, both office and retail have very low vacancy rate and strong take-up in the first half of 2021 in Guangzhou. So the feedback from the market is quite positive. So I don't see that much impact for all parties. Thank you.
Thank you, Sylvia. So speaking of managing commercial assets during COVID time, Link certainly has a lot of experience in managing office retail assets in both mainland China and Hong Kong. So George, would you be able to share with us your tips for investing and managing retail assets, especially during the difficult time of COVID-19?
Firstly, we want to make sure that our property provide a safe place for people to work and operate their business in. And so the first thing when we have to deal with COVID is cleanliness, increasing the confidence of our shoppers and tenants in our mall. Apart from that, I think we were just very lucky to be in Hong Kong and China compared to a lot of retail market. The government policy, while on social restrictions, did not stop construction work, did not stop fitting out work. So while we support our tenants and give them rental concessions, etc., some of the tenants do decide to terminate their business, and we've been able to replace those tenants very quickly because the fit-out work can just get done throughout this period. Over the last year, we have actually opened over 400 new shops and restaurants in Hong Kong, and over 100 in China, with only a few assets in China. And rental collection has been in the 95%, and partly because we don't have the restrictions that the overseas government have placed on retail landlords. There is an embargo of eviction in UK, in Australia, etc., where the tenants can decide not to pay rent and the landlord cannot ask them to go. And so I just say that we are very lucky in Hong Kong and China how the governments have decided to manage it, that we join hand with our tenants to go through this period. We share the pain. Some of the, for example, Chinese restaurant, gym, children activities, obviously have to either close down or limit their hours or capacity, and we as a landlord share that downturn with some rental adjustments. Some lease will restructure, but as soon as people starting to come back, we then focus on how to have good marketing activities to bring people back to the mall. And so far the results been very good, reflected obviously in the result that we have announced. So it's something that we call business as mutual. We're working together with our tenant. It's no longer business as usual. We have to work together and understand each other's needs. And so far it has worked out quite well for us.
Thank you, George. So far we've talked a lot about office and retail. I see a few questions here asking about alternative investments such as logistics, data centers, business parks, and life science parks, which have become increasingly popular as a result of COVID. I want to ask Francis, what are your suggestions on investing in these assets?
Thank you, Kathleen. I think it's a very special asset class, especially you mentioned data center, which is a very, very unique class of investment, and also require a lot of expertise in terms of the design, in terms of operation, and also the tenant is very special as well. So I would say that for something like Hong Kong, we are in the first half of this year. We have two investors buying two industrial property. One is a cold storage building, and then in the way to turn it into a data center in the next 2-3 years. And also, I think this month we also have another investor bought an old piece of industrial land, trying to rebuild into a data center. So that will take a long time to deliver the product to the market, but it's barely show that the demand is very strong. As you mentioned earlier on, that COVID has given people to work from home, work remotely, and also using a lot of data, using a lot of cloud capacity. So those, and also you mentioned like things like e-commerce and online trading. I think those again require a lot of data center to support the activities in these areas. So and also with COVID, definite life science is a up and coming topic, and also things like cold chain, cold storage, demand for food and also for pharmaceuticals is also up and coming. So I think this is a emerging new asset class for investor to consider. But some of the market are pretty hot, especially like logistics. I think been hot in Hong Kong and also been hot in China. Some of the yield has even compressed even down below that of retail and office. So we have to see the opportunity, and then of course these are mainly driving again with the background of there's a lot of liquidity, a lot of cash, a lot of capital chasing after these very special asset class.
Thank you very much, Francis. I see someone asked that the link has been so far focusing on retail and office investment in China's Tier 1 cities. George, what's your future investment plan? Will you consider investing in China's Tier 2 cities or take part of other asset classes?
Tier 1 cities will still be our main focus. We have expanded to the surrounding Delta area, so Greater Bay Area, Yangtze River Delta. We think that having a geographic focus like this provide us the operational synergy. If you look at the spending pattern and the numbers, tenants availability, talent availability, those four Tier 1 cities and the surrounding area probably are easier for us to manage, as we're still quite new in our investment in China. We just set up our China head office in Shanghai last year and trying to expand the team. You know, we will expand that circle, but not going to Tier 2 cities yet. For logistics, we have looked at a few portfolios, both in China and overseas, and I guess everyone is sort of chasing the price up, and so some of these portfolios we sort of pass what we believe can provide us the right return. So we haven't done any deals in the logistics sector. The demographic, I think, will support more growth in both retail and logistics that support online retail. Consumer pattern seems to have sort of two way of going. You know, both online and offline will continue to grow. I think it's not one taking over the others totally. And local competition is also very different in each cities. But I think 4 cities and the surrounding areas will keep us quite busy for some time. So I think we'll be a bit focused for now.
Thank you, George. So you mentioned overseas. I see another question asking, is there any investment plan or exciting project that will happen in Australia or New Zealand? I think that this question must target at you.
Australia and UK are 2 of the countries that we look at, and also Japan and Singapore. We're just waiting for Francis' call to tell us about what's next. No, we are actively looking at those. The office supply and the longer WALE in these established markets like London and Sydney with high liquidity are attractive to us. China's, we haven't really looked at too many office investments, partly because I think a lot of the larger companies in China tend to, you know, buy develop or buy their own building and put their own logo on top of it rather than renting. We find that there are less opportunity for us in terms of getting longer WALE assets in China with good credit tenant, whereas those are more available in places like Sydney and London, Japan, and so you know, for office, I think we have a slightly different geographic focus, but for retail, Hong Kong and China continue to be very attractive.
Thank you, George, for that. I see another question asking about investment opportunities in Guangzhou. So now coming back to Guangzhou, I'd like to ask Sylvia, where do you see opportunities in Guangzhou now? Any sectors or location that you would recommend to investors?
Okay. For traditional core business district in Guangzhou, like CBD, Zhujiang New Town, sports center are become very mature. So these 2 areas have been always the benchmark for office and retail rentals in Guangzhou. So if you want to invest in core or complex properties, I would suggest you to focus on Zhujiang New Town and sports center. And if you are interested in TMT concepts, then Pazhou will be a good idea. As you know, Alibaba, Tencent, TCL, VIP.com, which is called Weipinghui in Chinese, are also already in this area. another area is called financial town. Will be focused on development of financial industries. Many important financial platforms such as Guangdong Security Regulatory Bureaus, China Insurance Regulatory Bureaus, Guangzhou Bank, they're already in this area. So this is a financial concept. I also mentioned urban renewal in previous PPT. So this will be a new drive in Guangzhou in the next decade, I think, because many new villages will be developed in the future. So I believe JV corporations will be considered by investors. Thank you, Catherine.
Thank you very much, Sylvia. I see another question. I'll probably throw this to the panel, or I think Jamie, you have been quiet for some time, so maybe you can take lead on this question. What will be one major concern if COVID continues or rebound back in the future? Will the government continue to support the market in the retail and hotel sector? Jamie, would you be able to answer this one?
Well, yeah, I mean, I think it's a great question. I mean, it's certainly something that has been impacting the global markets in the last couple of days. A lot of investors now very concerned internationally about the resurgence of COVID and the Delta variant. However, obviously in mainland China, the situation is very much under close control. And I think actually Guangzhou is a perfect example of that. And I think Sylvia touched on the way the government had managed to keep the retail market going whilst having very specific and targeted controls to make sure that there wasn't a major impact on the market overall. So my sense is that obviously there are tight controls, tight tracking in China to make sure that we don't see a similar outbreak again. And if there is any outbreak, it's going to be controlled very closely. And of course, I think, in fact, even today, if you look at some of the lending rate today, the government is still very much looking to support the market overall. So they're keeping an extremely close eye on this. They're going to make sure that everything is taken care of. Any resurgence of the virus, I think, will be clamped down on very quickly. So I'm not super concerned about that in the mainland, but obviously it's having a big impact in international markets.
Right. Is there anything to add from Francis, George, Sylvia?
I had a dinner with George last night. He shared with us his experience 2 months ago when he go to New York also in Philadelphia. So he witnessed a very different situation in the US as well. So maybe George can share a bit of what he saw in these two cities in US.
Well, at that time, there's still requirement wearing masks and all that, and then actually quite a lot of people were doing so. So I was actually quite impressed. Very well managed. I think one thing that we've learned from that trip is that there is all the restaurants are now using QR code for the menu. Obviously, it's something that's not very new in China, but in the US. And in Hong Kong, people still hand you the menu, which probably during COVID times, one should be concerned about how clean it is. People are back into all the activities after CDC announced that once you have the 2 vaccine shots, you can take the mask off and go back to normal activity. So I think what we are looking at is how different cities and different governments are trying to plan for reopening. It will be a slow process. It will probably be a lot of opening and then restricting because the virus is not going away yet, and just how we are dealing with it. We were doing due diligence for the acquisition of Happy Valley while the Guangzhou lockdown happened, but Sylvia said it was locked down in certain areas. We just need to make sure that we don't go there so that our QR code doesn't change color. And then our team managed to get the deal done.
Excellent. Thank you, Francis. Thank you, George and Jamie, for insight on this. I see we only have 4 minutes left in today's webinar, and I would like to give the last couple minutes back to Jamie for final closing. Please stay with us, and over to you, Jamie.
Great stuff. Thank you very much, Catherine. And so just to summarize as we wrap up here, we heard from George that there's still great opportunity to improve income from assets and in the Guangzhou market. He also sees consumption patterns changing with opportunity on the back of metro infrastructure and a 7 days a week trading philosophy. George and his team have clearly developed a deep experience in the Guangzhou retail market, and they're really leveraging this to the max now. Francis also pointed out that some markets benefit from higher liquidity in the office markets around China, and this has proved attractive to some investors looking to transact. In Hong Kong, Francis sees investors looking at residential and en-bloc industrial buildings, and investors with good, strong local support are experiencing somewhat of a competitive advantage. Francis doesn't expect to see Hong Kong to be too quiet for too long. Sylvia's insight on Guangzhou was excellent and also points out that retail is still experiencing an upwards trend thanks to the government's highly targeted actions and controls. Sylvia highlights strong investment in infrastructure, and this will increase the competitiveness of Guangzhou. Leasing demand in the Guangzhou office sector is largely coming from TMT at around 35%, but retail's financial and energy sectors are also driving strong absorption. So huge thanks for today's panel, and especially thanks to our special guest, George Hong Choi, for joining us to share his insight. Thank you also to Francis for joining us and sharing his insight, and Sylvia for her insightful presentation. Do reach out to Sylvia if you need further information on the Guangzhou market. So as always, please drop Catherine or I a line if you wish to subscribe for our Asia Pacific Investor and Developer Newsfeed, quarterly market beats for over 33 cities in Greater China, or any other Cushman and Wakefield thought leadership publications. We will be back on Wednesday, 11th August at 10 a.m. Singapore time for our Asia Pacific update, featuring a spotlight on Singapore and Southeast Asia. Thank you very much for listening in. Keep in contact, and we look forward to engaging with you again soon. Goodbye.
Goodbye.
Thank you. Bye-bye.
Bye.